What if you could give generously to the causes that you care about and pay significantly less in tax at the same time? It's not a gimmick. It's exactly what my high net worth clients do year after year using smart IRS-approved strategies. Today, I'm going to walk you through the 3 most effective strategies that my clients use and are planning to use in 2025, from donor-advised funds to qualified charitable distributions and gifting of appreciated stock. I'm going to teach you how you can apply them to your own plan. And before we get started, my name is Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients make the most of their money. Let's jump into the video. If you're in a high-income year or you have large capital gains taxes, a donor-advised fund or a DAF could be your best friend. A DAF is like a charitable investment account. You contribute cash or appreciated assets, get an immediate tax deduction, and then give some of the money to nonprofits later, whenever you're ready. Our clients use it because you get an immediate deduction in the year of contribution. You can utilize a bunching strategy to stack several years into one giving year in order to itemize your deductions beyond the standard deduction limit. And there's also tax-free growth of funds while you decide where to give. And in 2025, the standard deduction is $15,750 for individuals and $31,500 for married couples, as it just passed the recent legislation with the Big Beautiful Bill. If your charitable giving doesn't exceed that, you might not get any tax benefit unless you bunch donations through a donor-advised fund. So here's a real-world example. Imagine a client sold their business this year, creating a $1.2 million taxable event. So we moved $100,000 of appreciated stock into the donor-advised fund. They avoided $20,000 in capital gains tax, they got a full deduction for their charitable contribution, and they have years to distribute the money to causes that they care about. And a bonus here is you can even name the fund. So if a legacy opportunity for your family is something that's important to you, this is a great way to do it. And before we go into the next strategy, I want to revisit the bunching strategy with your donor-advised fund. Let's say you've been giving $10,000 a year to a charity because that's what you've done for decades and that's just what you plan to continue doing. But this year, the $10,000 that you're giving won't be quite enough for you to itemize deductions because of the higher standard deduction limit. Now, you could just give the money and forgo the potential to itemize, but there is a better strategy if you want to not only maximize who you're giving to, but maximize it from a tax standpoint as well. If you hold that $10,000 of the following year, and you could even do this January 1st of the following year, it will allow you to potentially combine it with the $10,000 that you're going to give in that following year and allow you to be able to itemize your deductions in that subsequent year. So giving money is a charitable thing to do. Putting a little bit of strategy behind it not only benefits who you're giving that money to, but could help you save thousands in the way of taxes by having a little bit better of an idea of what you want to do and how you want to distribute these funds instead of just foregoing the money and giving it without a strategy. This next strategy is a must-know for retirees. If you're over the age of 70 and a half and you have an IRA or a traditional 401k, you can give directly from that account to a qualified charity and have it count towards your required minimum distribution without it showing up as taxable income on your return. And just to clarify, your required minimum distribution is money you have to take from a tax-deferred retirement account every year. It's based on your age and the previous year's balance. Most people had to start taking a required minimum distribution between age 70 and 75, depending on the year in which they were born. So now back to the qualified charitable distribution component. In 2025, the QCD limit has increased to $105,000 per person from $100,000 last year, thanks to inflation indexing. And why this matters is because it satisfies your required minimum distribution, but it doesn't increase your taxable income. It keeps your adjusted gross income rather lower, which helps reduce your Medicare premium or IRMAA surcharges, reduces how much of your Social Security gets taxed, and avoids on tax credits or deductions. So let's just go through a brief example. Let's say your required minimum distribution is $50,000, and you send that $50,000 directly to a charity instead of withdrawing it and putting it into your checking account or taking cash out at the bank. That $50,000 never hits your tax return. You've supported a charity that you care about, and you've protected your tax bracket. If you're charitably inclined and over the age of 70 and a half, a qualified charitable distribution should be your go-to strategy. Just be sure to make sure that you never take physical receipt of the funds. You want the money going directly from your account to the charity. For my clients, what I do is I often will generate a check in the name of the charity that they want to send it to and send it directly to the charity. And that charity then gives them some correspondence saying, hey, we got your funds. We're going to issue you a 1099 at the end of the year from my company, and we'll match that up. So that way, when they go to file their taxes, the IRS knows they're never going to pay a dime of money on that distribution. This next strategy is one that is very underutilized, but incredibly tax efficient. If you're sitting on long-term appreciated investments like stocks, ETFs, or even crypto, gifting them directly to charities allows you to avoid capital gains tax entirely. This is smart because a charity will receive the full asset value. You get a deduction for the fair market value, and you eliminate the embedded gain from your portfolio. The pro tip here would be to donate the stock and replace if you have cash available. Let's say you plan to donate $10,000 in cash to your alma mater, but you also have in your portfolio $10,000 worth of Apple stock with a cost basis of $2,000 or an $8,000 unrealized gain, and you're still bullish on that stock moving forward. In this scenario, you'd want to gift the stock instead of the cash. You would avoid that unrealized capital gain in your portfolio and then buy that Apple stock with the cash you have on hand. It gives you the same exact portfolio exposure, increases your cost basis because you're buying it at a higher basis, and it lowers your tax bill in the future. You can also utilize this strategy inside of your donor advised fund to supercharge the tax benefit. Now, there is one bonus strategy that I wanted to leave you with today. And if you're thinking about giving over $500,000 in gifts or legacy planning in general, we sometimes recommend charitable trusts. There's two types of charitable trusts that we see used most often. The first is the charitable remainder trust, which is where you get income from the trust for the rest of your life, and then the residual amount left over goes to a charity after you pass. There's also the complete opposite, which is the charitable deed trust, which in this instance, the charity will get the income payments for the rest of your life. And then once you pass, your beneficiaries will get what's left over from that trust. These do require legal setup, but they do help to reduce your estate tax, shift income, and support causes over decades. For many clients, these trusts become a core part of their wealth transfer strategy, blending philanthropy with tax efficiency. So let's do a brief recap. If you're a high-income earner, maybe you sold a business, exercised stock options, or received a big bonus, a donor-advised fund can help you reduce your tax bill while supporting causes you care about over your lifetime. If you're over the age of 70 and a half and taking required minimum distributions, consider a qualified charitable distribution. It satisfies that RMD without increasing your taxable income. And if you're holding low basis stock or assets, gifting those directly to a charity allows you to avoid capital gains entirely and get a full deduction in the year in which you give that gift. And finally, if you're planning to give $500,000 or more and you want to build a legacy over time, a charitable trust, whether it's a charitable remainder trust or a charitable lead trust, might be the most effective structure. Giving feels good, but giving strategically, that's where you multiply your impact. So if you're already giving or you want to, don't leave money on the table. These strategies help you give more, save more, and build a legacy that lasts. If you want to explore which of these options fits your goals best, schedule a call using the link below. We'd love to help you build a custom giving plan. If this video was helpful, give it a like, subscribe, and leave a comment. Let me know what cause you care about the most. I'll see you in the next video.